Good morning. I'm Bonnie Kelly, and I'm the editor-in-chief of the Journal of Law, Economics, and Policy here at Antonin Scalia Law School. Welcome to our 14th annual symposium, Regulatory Reform, Transparency, and the American Economy. The Journal thanks the Law and Economics Center and the Federalist Society for co-sponsoring and bringing our program together, and we thank all of you for choosing to spend your day with us. All of us involved today are committed to being an open forum for thoughts and ideas, and to see more people here today than ever before is wonderful. We are excited to serve as an outlet for this topic, and we hope you share that excitement. So again, welcome and thank you.
Good morning, everyone. My name is Devon Westhill. I'm the director of the Regulatory Transparency Project at the Federalist Society. And I think part of what my role here for just 2 minutes is to do is very much what Bonnie just did, and thank you on behalf of the Federalist Society and the project for being here today. You could be anywhere, but you're here with us, and we really appreciate it. I think you're going to enjoy the symposium today. There are an amazing array of speakers and topics that we'll be discussing. And I hope you'll take some of what you learn back with you. I know that many of you are from many different states around the country, so thank you for being here, and please take it with you. I want to thank a number of people or organizations, I should say, the Law and Economics Center and their staff, Greg Conkle and Todd Zywicki, for even thinking about co-sponsoring this with the Federalist Society's RTP. They've done a great job in putting this together. As Bonnie mentioned, I've been told that throughout today, there will be more people actually attending the symposium than have ever attended the Journal of Law, Economics, and Policy Symposium. So thank you all for being here, and thanks Greg, and thanks Todd, and thanks staff at LEC for helping with that and actually really leading the way. Also, I would be remiss if I didn't say thank you to the authors of the papers that are being presented today. These very distinguished individuals have worked very hard to put together these papers and many other things as well. What I should say is that what you see today is only the tip of the iceberg, so to speak, for what the RTP is doing. A great tip, but just the tip of the iceberg. We've got a lot of other things that we're doing with the Regulatory Transparency Project. If you're interested in what we're doing, you can go to regproject.org. It's regproject.org. We've got papers, we have a podcast series, we have mini documentary videos, and we're actually in production right now of a feature-length documentary film on regulation and the impact on innovation. So I encourage you to do that. I encourage you to stay in contact with us. We have a number of different subject areas at all levels of government that we're pursuing and trying to create a national conversation around, and we're glad that you're joining with us and doing that. And with that, I think I'm supposed to turn it over to Paolo, our moderator. Wonderful. Thank you very much.
Thanks, Devon. I'm very excited to moderate this first panel of the day. And so this panel is titled Financial Innovation and Innovative Financial Regulators. I have a wonderful group of panelists. From my right is Chuck Cooper of Cooper and Kirk, who's going to present his paper about banking regulators and Operation Choke Point. Todd Zywicki is a professor here at Antonin Scalia Law School. He's going to present a paper about the Consumer Financial Protection Bureau protecting consumers from themselves. And then we have David Vladeck from Georgetown Law Center, who's going to be the discussant of the papers. Each panelist is going to have between 10 and 15, 18 minutes to present the papers, and then we're going to have the discussant. I'm going to give the option to the panelists to rebut the comments, and then we're going to open. Want to do that. And then we're going to open the panel for question and answers. Okay?
Tom first. Thanks. All right, thanks. I'm sorry Deepak couldn't be with us today. So he had a the medical issue arise, so I'm sorry he won't be here to rebut my comments, but I'm sure he'll watch the tape and tell me afterwards why everything I say is wrong. Thanks for being here. Well, I was one of the co-authors on the paper involving consumer protection, focusing on the Federal Trade Commission and the CFPB. Co-authored, the other primary co-authors were Tim Muris and James Cooper, two of my colleagues here at Scalia Law School. They wrote most of the FTC stuff. I focused mostly on the CFPB stuff. We all helped with each other's things. But so I'm going to focus primarily on the CFPB and consumer financial protection this morning. But a lot of what I say, the overarching themes and the like, will be applicable as well to conceptually to FTC type issues. And so what I'm going to do is the first part of my talk is going to be a little bit pell-mell. I'm going to move through some data fairly quickly and then kind of get to my view of regulatory reform based on that. The data is going to be presented mainly just kind of show you that I know what I'm talking about and I have basis for what I'm saying, but we can certainly revisit it later if people have questions. So now I think of this as the consumer protection policy dilemma, which is that there are two concepts that are sometimes in conflict. On one hand, you've got traditional consumer protection concerns. These are things like asymmetric information, information costs, market power, that sort of thing, right? And those are the traditional justifications for consumer protection. But then you also have, on the other hand, things like consumers also benefit from competition, innovation, lower prices, and greater product variety, right? And so sometimes these two things are in conflict. But often they are not in conflict. And this is an important point, which is that sensible regulation can help consumers, lenders, or businesses, and the economy. Because basically the idea is that when consumers feel confident, right, when consumers feel like they're being protected, they can increase their demand for product. Right? So think, for example, about debt collection, right? Think about debtors' prisons, right? While debtors' prisons might increase the likelihood that a lender would lend, debtors' prisons, for if somebody doesn't pay, is going to substantially decrease the demand for credit, right? So it could be that everybody's probably is the case that getting rid of debtors' prisons is good for both consumers and lenders, right? Neither of them want to have debtors' prisons because if those remedies are too harsh, people won't borrow. And so what you want to try to find is the sweet spot such that regulation, by promoting transparency, by promoting overcoming information costs, give consumers the confidence to borrow, which then is good for lenders and the economy as well. And you can apply that to just about any other consumer product, whether it's cars or pharmaceuticals or whatever, right? They're not necessarily in conflict. And that's basically the challenge here, is how do we strike that balance? Now, when I think about it, you could think of sort of a three-step test for thinking about whether government intervention is the appropriate way to deal with the consumer protection question. First is there a market failure, right? Is there actually a market failure? And a second is, will the proposed government action mitigate the market failure? Right? And part of those first two steps is, if there is a market failure, is there also a market solution? Right? To what extent do markets provide their own solutions to what might otherwise be a market failure? So consumer reports, for example, being a classic example of the fact that consumers have a demand for information. They have a demand for reliable third-party information, and that market demand is met by something like consumer reports or by Amazon reviews or Yelp or whatever, right? Those are part of the market solution to what would otherwise be a market failure. Then the third part is if you do decide that there's a market failure and that government action is the right way to deal with it, you still have to ask the question, which is, will the benefits, both intended and unintended consequences, exceed the loan or the cost? And in the context of consumer credit, this is especially pressing, right? Because in order to make a loan at all, you've got to either be able to price the risk efficiently in terms of the interest rate, the down payment, and the like, or if you can't price the risk efficiently, you've got to reduce your risk exposure, such as lending less to everybody, or by not making loans to certain people, especially higher risk borrowers, right? And the final point here is that eliminating the supply of credit does not eliminate the demand. Eliminating the supply of credit does not eliminate the demand. If people have a need for credit, such as short-term loans and the like, they're going to seek that out even if it can't be supplied legally. Now, I think of this in terms of two different ways, orientations toward how we might think about consumer protection. First is I call basically market reinforcing regulation, which is basically takes the basic premises that markets work pretty well, and what you want to do is create rules that work better to match consumers with their desired products. So a good example of this would be the original Truth in Lending Act, right, which was designed to create simple shorthands for consumers to be able to compare products and the like, right? Now, one of the things that's interesting about that is it's kind of gone off the rails a lot. Truth in lending has gotten very complicated, but even the ideas of truth in lending have kind of gone off the rails, which is APR, for example. APR is a shorthand that allows consumers to compare different products, right? What we've turned APR into is something that people think of as a price. It's not a price, right? It's not a price, it's a proxy for cost or price, right? So comparing the APR on a payday loan to the APR on a mortgage, you know, a 2-week loan or a 3-week or a 1-month loan, comparing that to a 30-year mortgage, that's not a meaningful comparison because they're not really prices, right? But market forcing regulation tries to come up with ways of facilitating consumer choice to figure out what they want versus market replacing regulation. These are things like usury ceilings, the Credit Card Act, which we'll talk about a little bit in the like, right? And the question we have to ask ourselves is what is the problem we want to solve and what is the best tool to solve it? Which is, if it's an information problem, we want to have an information solution. If it's some other problem, then we may want to have some other solution. So now I'm going to move through and focus on CFPB from here, right? And I refer to this as the Obama regulatory onslaught in consumer protection, starting with the Credit Card Act, also talking about Dodd-Frank, the Durbin Amendment, and the various things that we have in with the CFPB. I'm going to just run through some of these to show where I think over the past several years, regulation has tended to gravitate towards market replacing regulation rather than market reinforcing regulation, banning products, limiting consumer choice, and the unintended consequences that flow from that. So here we go. Start off with the Card Act in 2009. The Card Act basically limited the ability of banks to be able to price consumer risk accurately, and in particular to be able to adjust interest rates and other things when consumers become more risky. This is data taken from, I believe, Greg, this is your paper. Greg Eliason is here from the Fed. It shows in the period that we see since the Federal Reserve regulations of 2008 that predated the Credit Card Act, what we see here is that between that period and 2011, the number of low-income households with credit cards fell by 11 percentage points. What we see here is that the ability to price risk didn't really affect the wealthiest households, but it had a very dramatic effect on low-income households, causing them to lose credit cards. As we said, being unable to price your risk accurately means you lend less to riskier borrowers. These are just some various studies and opinions that were done that sort of reinforce this in a variety of different ways. The graphic, which is that credit card lines were closed, consumers, and in particular, higher risk consumers lost access to credit cards and were driven out of credit cards. Now, these are very difficult studies to analyze because at the same time, of course, we had a banking crisis and a recession and that sort of thing. But all things point to the Credit Card Act at least as having some impact on this. This is the Durbin Amendment. The Durbin Amendment put price controls on interchange fees. Those are the fees your bank pays when you buy something at Target. For banks over $10 billion, they cap those. And essentially what this shows is interchange fees were cut in half by the Durbin Amendment. What was the impact? Well, basically what happened was that those costs were passed on to consumers. This is a chart that shows the percentage of accounts eligible for free checking beginning at that period. At the beginning of the 2000s, less than 10% of bank accounts were free checking. By 2009, it was 76%. And what we see is since that time, since the enactment of Dodd-Frank and the Durbin Amendment, starting with some restrictions on overdraft, but then from there, what we see is that since that period, the percentage of households with free checking accounts with free checking has fallen in half, from 76 to 38%. I don't know if you have to be an economist, and it's 9 o'clock in the morning, but I don't know if anybody can guess when the Durbin Amendment was passed, looking at the data on bank fees, right? Mid-2010 is when, July 2010 is when Dodd-Frank and the Durbin Amendment were enacted. And what we see is immediately, for those who pay bank fees doubled. During that period. The yellow bar is when the final Federal Reserve regulation went into effect, right? So dramatic response to the Durbin Amendment, and these impacts on the loss of free checking and the like were only limited to banks, large banks affected by the Durbin Amendment. Small banks have not retrenched on these things, right? So what's the impact? If we look at credit cards and we look at the Durbin Amendment, what have we seen? We've taken away credit cards from low-income people. We've taken away bank accounts from low-income people, right? So what we saw in the period after the Durbin Amendment was the unbanked population grew by about 1 million. It's recovered to some extent now, right? But basically low-income people losing free checking, being forced to pay higher bank fees, washed them out of the mainstream banking system. Those of us in the room probably didn't even notice this, right? Remember, higher income households weren't affected by the Credit Card Act. Higher income households weren't affected by the Durbin Amendment. You may not even know it, but they increased the minimum balance we had to have to be eligible for free checking and the like, but most of us weren't generally impacted by these rules. Low income households were affected by these rules, right? And the effect is what? After we've taken away credit cards and taken away bank accounts, what happens? Payday lenders, pawn shops, prepaid card issuers have flourished, right? You could take away the supply, but you can't take away the demand. And so what's happened is people have fallen into these alternative products such as payday loans, to which the response of the CFPB, of course, was to do what? Too many people want payday loans, so we need to ban payday loans, right? And history tells us where this ends up, right? That in the end, what we end up with is people falling further and further and essentially eventually into the black market. You can also look at things like the mortgage rules, right, which strapped on a whole bunch of new regulations. The studies of the impact of the ability to repay rule and the qualified mortgages rule is that those disproportionately have had the impact of an adverse impact on low-income consumers. The way that these things work is that the way they calculate the cost and stuff, it's much more difficult proportionally to make a $100,000 mortgage than a $600,000 mortgage because a lot of the costs are the same. So you've got a smaller lending base to amortize this over. And so basically what these studies show is again and again and again, the upper end of the housing market is recovered. The lower end of the housing market, consumers continue to have difficulty getting access to credit. Somewhat ironically, what's been the effect? Non-bank lenders now make over half of the mortgages in this country, basically because bank lenders have exited the field. And the amazing thing about these rules is that there's no evidence that they would actually do anything in a future crisis like our current crisis. Why? Because they're focused completely on the consumer's ability to repay and do nothing about what turned out to be probably the biggest factor in the foreclosure crisis, which was the deterioration of down payment requirements and people stripping out equity from their homes, such that when their houses were underwater, it became profitable for them to walk away when the housing prices fell. Another factor is the impact on competition, which is that the regulatory onslaught of the past few years has fallen hardest on small banks. Right? Small banks have exited the provision of products such as mortgages. And basically the economics here is pretty straightforward, which is that a lot of regulatory costs do not scale with size. Right? You have to fill out the same forms, a lot of the same forms, if you're a $100 million bank or a $100 billion bank. When you impose new regulations, some mega bank in New York, they can hire 150 new compliance people and it's a rounding error. Right? If it's some small bank, community bank, hiring one more person is a huge impact on their profits. And so what we've seen is that the cost of Dodd-Frank and the like have fallen disproportionately heavy on small banks. And what that's done is ended up stifling competition. Small banks have been shrinking. And ironically, big banks have been getting bigger. right? So we've reduced competition and consumer choice. It's also impacted the economy, which is that community banks make most of the small business loans in this country. And as small banks and community banks have merged or folded or disappeared or have not been created, we've seen a dramatic reduction in the amount of small business lending, and that's impacted economic recovery. A famous quote was by Jamie Dimon of J.P. Morgan Chase, who once said that Dodd-Frank has widened the moat between protecting big banks from competition by small banks. And Lloyd Blankfein of Goldman Sachs said that Goldman Sachs and other big banks would be, quote, among the biggest beneficiaries of Dodd-Frank because of all these regulatory costs. So let me spend my last a couple minutes talking about what might a new approach for CFPB look like and what might be the pillars of a reform strategy going forward. And I identify an overarching view, which I think is sort of what holds together the Trump regulatory agenda, which is restoring economic prosperity and the rule of law. And under that, I think of 5 pillars of a reform agenda. We could talk about these more in the discussion. What I call innovation, inclusion, choice, competition, and respect, right? First, innovation. This is where things such as the criticism of the CFPB for engaging in regulation by enforcement, right? People don't know what the rules are, and so they've been very reluctant to innovate, to create new products, new ways of delivering products, and the like. Things like the Project Catalyst that the CFPB adopted to try to incubate innovation have been largely stillborn, as has been its no action letter process, right? I would urge the CFPB to look abroad. There are a lot of other countries that have adopted very robust and creative regulatory sandbox approaches that are designed to create a way of furthering regulatory efforts, but also promoting innovation so that people aren't afraid to try new products and the like. And also, obviously, change these other things. Inclusion, as you've probably picked up, this is a passion of mine. I think it's a moral imperative that we reverse the financial exclusion that has been going on over the past decade. I think the idea that we have taken away credit cards and bank accounts from the most vulnerable and low income and younger consumers is an outrage. And that we've caused people, and there's a legitimate place in the consumer credit ecosystem for things like pawn shops and payday loans, in my view. But I don't think that's where we want to encourage people to go, because we shut off access to things like credit cards, mortgages, and bank loans. And I think one of the things we can think about here is thinking in terms of what are the incentives that we're creating for banks to offer products to low consumers? What are the incentives that we're creating? Working with incentive-based ways of treating low-income consumers as valuable customers rather than basically using mandates and treating them as charity cases. Choice. I think that reorienting ourselves towards recognizing that by and large consumers know what's best for themselves and their families, right? And focusing our regulation on how consumers actually choose. And a good example is payday lending and overdraft protection. The evidence is compelling that consumers look at payday loans and overdraft protection as very close substitutes, and that they choose between those products rationally, given their limited context, right? Given what their alternatives are. They're for people who don't have access to credit cards and the like, right? Traditionally, payday loans and overdraft, payday loans are regulated on the state level through basically enforcement-based model. Payday loans are basically bank supervision examiners on the federal loan, overdraft, right? We kind of kept that silo approach at the CFPB of treating those as separate products as they're regulating them. I think a more innovative way of thinking about regulation would start with the consumer basis, think about how consumers use these products, and think about how we regulate those two products together, for example, in terms of how they compete and how consumers choose them. Competition. I think we have to do something to give regulatory relief to small banks. We need to do something that treats bank and non-bank lenders on more equal terms and the like, and recognizing that competition and allowing that small banks have a legitimate role in the consumer credit ecosystem as well. And finally, I think respect, which is let's treat borrowers like adults, right? We want to the most important thing that CFPB can do, what it's set up to do, is protect consumers from fraud and deception. It should do that. It should continue to do that. But at the same time, we should not be banning products. We should not be saying you can't take out a payday loan without putting anything in its place, because that's what we currently do. So we take away payday loans, and then there's kind of a wishful thinking that some other product will emerge, and often those products aren't even legal in most of your states, the products that they want to have. But there's also more to this, right? Which is a good example is foreclosure, and this will be my last point, Paolo, is this foreclosure point, right? Which is that if we don't recognize that when we set up incentives and we don't do anything about down payment requirements, right? Consumers over time respond to incentives, right? The best investment a lot of people found during the financial crisis is if your house is $80,000 or $100,000 underwater, the best investment you're ever going to make is walk away from it, right? And so if we set up rules that are designed on the basis that consumers are irrational, what does that do? That just provides incentives for consumers to act rationally and exploit the system. Now, not all consumers do that, obviously, but we need to, but we need to be aware that there are both consumer protection issues and incentive-based issues. And the last point is restore economic prosperity and the rule of law, and I think that's exactly the perfect breaking off point to turn the podium over to Chuck Cooper to talk about some rule of law issues involving financial regulation. Thank you.
Well, good morning, ladies and gentlemen. And I want to thank the Law and Economics Center and the Federalist Society for organizing this event and for inviting me to participate. I have our moderator's permission to present from my spot here on the platform, so I hope you don't mind. And as you've heard, I'm going to speak about something called Operation Choke Point. A regulatory strategy, I would say actually a regulatory abuse, essentially invented by the Department of Justice and implemented by the banking regulatory agencies. But the story begins, at least for me, in the early fall of 2013, just as President Obama's second term was starting to pick up some speed. And banks throughout the country began very abruptly terminating their banking, their financial relationships altogether with a variety of their longtime merchant customers. And this was only certain types of merchant customers, primarily firearms and ammunition dealers and payday lenders. There were also a few other types of merchant lenders merchant customers that actually came within some of the grips of Operation Choke Point, coin dealers, and in fact the pornography industry as well. But these were all entirely lawful, and in some cases, such as payday lending, substantially regulated, at least at the state level, types of businesses. Now, I'm going to speak about the payday lending industry because that's something I know about because I've been representing it in a lawsuit against the banking regulatory agencies over Operation Choke Point. But these terminations were not isolated geographically. They were occurring basically dispersed throughout the nation. And they weren't focused on specific payday lenders. Those, for example, suspected of having engaged in deceptive practices or any other kind of wrongful activity. Again, this industry is in the places where it is lawful, which is almost throughout the United States. It is regulated by state regulatory bodies. The banks also were terminating not just some of their financial engagements with these customers, but all of their financial products, terminating the relationships altogether, and not just with some payday lenders, but with all payday lenders en masse industry-wide. It mattered not to the banks how long-standing those relationships were, nor how profitable they had been. They were terminating relationships that had been for, say, 20 years, highly mutually beneficial relationships, highly profitable to the banks themselves, relationships that the banks had often actively solicited themselves and that they had carefully nurtured over this period of time. Then all of a sudden, abruptly started terminating. When the terminations came, they were accompanied by the bank to its former customer with earnest expressions of regret, usually verbal, sometimes in writing. Let me give you an example. This was from a letter of termination by one of the banks to one of its payday lenders. We have appreciated your account relationships and the business which you have done with the bank, and we are not aware of any account activity in your accounts or your business relationship with us that would constitute any violation of any law, rule, or regulation to which either of our organizations is subject. So there's no business explanation for this strange phenomenon. No change in the payday lending industry's general reputation or its practices. No change in its credit worthiness or its value as a client. No change in the business climate that affects the payday lending industry. Now, the bank regulatory agencies themselves advanced both before and during, and to this day, with one exception, what I call the Sergeant Schultz defense. Now, I see a lot of people in the room who will not know what I'm talking about, but many who will. The Sergeant Schultz defense. Sergeant Schultz was a German guard in a POW camp in World War II, after in a television series when I was a young kid, and he was famous at the time for saying, "I know nothing." Well, the banks have been saying, "We know nothing about this," essentially saying that to the court, to the plaintiffs, to the industry itself. In other words, what they're saying is that, throughout the country, suddenly and abruptly, and simultaneously and independently, banks just out of the blue started terminating these long-standing, highly profitable relationships that they regretted terminating for no good reason. It's not entirely believable. And by the time we filed our lawsuit in August of 2014, 80 banks, again dispersed throughout the country, had terminated all their relationships with payday lenders. 80 banks. Now, they say lightning doesn't strike in the same place twice. I don't know whether that's true. I suspect actually sometimes, rarely, it actually does. But lightning doesn't strike 80 times in the same place simultaneously. So the truth is that the banks began to choke off these financial services of these particular merchant clients in particular, and dominantly the payday lending industry, because they were disfavored. They were disfavored by the banking regulatory agencies. They didn't like these entities, and they basically designed a plan. The DOJ in particular designed a plan, and the banking regulatory agencies, as I mentioned, implemented it to literally choke off the financial oxygen of this entire industry. And it took the form of a two-step process, essentially. The first stage was providing the legal hook, really, the legal foundation for the implementation stage that was to come. They did that by redefining something called reputation risk. Now, reputation risk is part of the longstanding risk profile that banking regulators look to when they assess the safety and soundness of a bank. And reputation risk is the risk that a bank, endures or takes on by its own activities that may be called into question, may be shady. Any kind of deceptive practices or sharp business practices that would impact the bank's reputation itself is a risk to its soundness, ultimately to its safety. And that obviously makes perfect sense. In the days before, and shortly after the Obama administration came into office, reputation risk was redefined. And it was redefined only in these very informal guidance announcements and notices and letters to the regulated industry, that is the banks themselves. And it was redefined to say that the bank not only must take care to protect its own reputation for solid and upright and proper practices and any other types of activity that might reflect poorly on the bank, but it also has to care about its customers' reputations. So the idea of reputation risk was suddenly extended beyond the bank's reputation to all of its customers. Completely innovative and through informal means. And I'll come back to the significance of that momentarily. And it simultaneously issued a list of 30 types of businesses that it considered high risk, payday lending being at the very top. But 30 types of industries, many of which are, in many respects, have poor reputations and reputations for illegal activity and deceptive practices. But again, many entirely lawful and regulated industries, but politically controversial industries, including especially the payday lending, but firearms and ammunition dealers, coin dealers, credit repair agencies, things such as this. Now, the banks were often candid with their now terminated former clients, former customers, in their verbal discussions with them, but they were very guarded typically in the letters that they sent terminating those relationships. Rarely did they mention anything other than regulatory activity at all, sometimes referring to the regulatory environment in very general terms. There is one exception, however, and it's in the same letter that I quoted from earlier, where a bank expressed its regret for having to terminate its relationship. In that letter, the bank explained to its payday lender client, former client, that it was terminating due to warnings by federal regulators of future adverse consequences to financial institutions who provide deposit and transaction services to payday lenders, and the lack of any clear guidance on which our bank may reasonably rely in conjunction with providing such services. We must reluctantly discontinue account services to all payday lenders, which would include your accounts. So, an express reference to the regulatory pressure and unclear regulatory pressure that it was under. And these pressures, by the way, were communicated in the back room. The bank examiners were sent to their banks, and were told that we don't like payday lenders, we don't like firearms dealers, we don't think you should be doing business with them, and we are not going to look favorably upon you in a regulatory light if you continue doing so. There was another kind of jarring account that Chairman of the House Judiciary Committee, Goodlatte, reported. The Judiciary Committee and the Financial Services Committee, both of the House, did investigations into Operation Choke Point. And this is one thing that the Judiciary Committee reported. The committee obtained a jarring account of a meeting between a senior FDIC regulator and a banker contemplating serving a payday lending client. The official told the banker, "I don't like this product, and I don't believe it has any place in our financial system. Your decision to move forward will result in an immediate, unplanned audit of your entire bank." So this is kind of backroom regulatory pressure that was being brought to bear, and that was being brought to bear very effectively throughout the country. Now, again, the banking regulatory agencies did this through backroom, very rarely putting any of this information on paper. But our discovery did hit some useful information. Here's an excerpt from a letter that one of the FDIC's regional directors sent to a bank from the Chicago regional officer. And these are just some excerpts. "We have recently become aware of your banks," it was redacted, the banks and the payday lender were redacted, "your bank's involvement," this is from the FDIC to the bank, "involvement in activities relating to payday lending, specifically the processing of transactions on behalf of," and then redacted the name of the payday lender. "It is our view that payday loans offer limited utility for consumers as compared to traditional loan products. Consequently, we have generally found that activities related to payday lending are unacceptable for an insured depository institution. Members of our region's senior management will contact you in the near term to schedule a meeting to further discuss our concerns relative to the aforementioned relationship." And so one can only imagine how that conversation went. Again, the fulcrum for Operation Choke Point was reputation risk, a very subjective, easily manipulable concept that could be readily used by any banking regulator in any administration to visit this kind of pressure, essentially to choke out any disfavored institution. One can easily imagine what conservative administrations would target if this authority were ultimately to be condoned or not prohibited by our courts. The good news is that this kind of activity is not appropriate under our laws. The APA, its very purpose is to see to it that these kinds of regulatory measures, if they are to be pursued, are pursued only after a process of notice and comment where the regulated industry, the customers or the merchants that might be targeted, have been given an opportunity to know what's coming and to make comments and ultimately to challenge that type of regulatory, subjective regulatory metric, if you will, if they so choose. It's also part of our lawsuit that the due process clause has been violated by the banking regulatory agencies in this case, both by denying what the Supreme Court has recognized as a property interest in their bank relationships and depriving them of that without any process other than what they've received in the back room, any process at all for the payday lenders, and only process as it was according to the banking institutions in the back room, and have in the process deprived them of their reputations, at least for lawful and appropriate and non-deceptive, non-wrongful conduct. So the bottom line I would submit to you is that this regulatory strategy, I would call it a regulatory abuse or jihad, that the previous administration undertook to target politically controversial and disfavored types of businesses should alarm anybody, liberal or conservative, in terms of its potential for abuse. It puts me in mind of Justice Jackson's warning in Korematsu that if this takes root, as he said it, the principle then lies about like a loaded weapon, ready for the hand of any authority with a plausible claim of need. Thank you.
Good morning. These are hard acts to follow. Let me thank Paolo for inviting me. It's just great to see my old friends. Chuck Cooper's one of the finest lawyers in the United States. You've seen that now with his presentation. And Todd sounds sort of like he's running for an appointed position like, at the CFPB, and we could do, and that would be a good thing.
It would indeed. Hear, hear.
So let me start out with a general critique of the papers and to some extent the talks this morning. I'm always skeptical when policy is driven by anecdotes, many of which I think are off base or wrong. Some may be true, but these papers are mostly anecdotal. They contain a lot of inflammatory rhetoric. They don't spend hardly any time at all examining the statutory mandate of these agencies. The FTC part of the paper just simply ignores what the dictates of the FTC Act are. They don't pay any attention at all to contrary legal authority, sometimes controlling legal authority, or regulatory policies that don't fit in within the paper's narrative. So I think these papers are about as fair and balanced as Fox News. So let me start talking about Operation Choke Point. Now, when I was at the FTC, we were participants in the beginning of Operation Choke Point. And Operation Choke Point had nothing to do with lending. It had to do with payment processing. And if you look at the, quote, industries, I love this quote here. This is from the paper. With this legal hook in place, the Justice Department and its allies in the banking industry moved to stage 2 of their campaign to choke off disfavored industries. Now, if you look to see the footnote, most of these are not industries at all. These are scams. And the point of Operation Choke Point was to cut off payment processing, and now I'm just quoting from the paper, credit card scams, dating service scams, debt consolidation scams. You know, my favorite, because it was one of the most egregious scams during the midst of the downturn, were government grant scams. We shut down a $1 billion government grant scam that was enabled only because payment processors were processing these payments. $1 billion of money taken out of the wallets of poor people processed by payment processors. And so the aim of this was not credit. It was to stop processing fraudulent transactions, to go after the choke point that turned in a credit card number into hard cash for scammers. And most of the banks were supportive of this because The way you detect fraud, or one way you detect fraud, is simply to measure the percentage of chargebacks. Every anti-fraud agency measures chargebacks. High rates of chargebacks are a signal, not proof, but a signal that the program is a scam. And so that's the origins of Operation Choke Point. Chuck tries to paint payday lenders as if they were highly regulated. That, at least during the period in the aftermath of the downturn, simply was not true. Payday lenders started affiliating with Indian tribes and took the position they were immune from both state and federal regulation. We were involved in many cases in which essentially the payday lender claimed that the federal government had no authority over it because it was affiliated with an Indian tribe. There are states that outlaw payday lending, but there are internet lenders all over the country that service those states. Moreover, if you look at the enforcement actions taken collectively by the states, by the FTC, by the CFPB, they're disproportionately aimed at payday lenders. Why? Because they don't necessarily tell the truth. They're not the goody two-shoes that Chuck has portrayed them as. This is an industry that has long been rife with problems, and so it made the list. Now, I don't know, and I can't speak at all about some of the, what I think Chuck would call strong-arm tactics that were used by some of the banking agencies. To the extent they engaged in those kinds of threats, I think Chuck is right. That is wrong. They shouldn't have done that. If that happened, there ought to be consequences for that. But the point of Operation Choke Point was to cut off the ability of fraudsters and scam artists and people who cheat from getting access to getting their credit card payments paid. That's the point of it. If there were excesses, and there may well have been, I don't doubt, I take what Chuck says to the bank, there ought to be consequences to it. But the basic thrust of Operation Choke Point made a huge amount of sense. And you have to, again, put this in perspective. The economic downturn was a massive, massive issue for fraud. Because the one thing, we know a little about why people are subject to fraud. And it generally does not come down to any of the things that you might think. Age, old people slightly more liable to be defrauded, but not much. Education, nowhere near as much of a factor as you would think. Mm-hmm. The key factor to make someone susceptible to fraud is perceived financial insecurity. Huh. So if you were rich and you're less rich, you're vulnerable to fraud. If you're middle class and one of the spouses loses a job or experiences some period of unemployment, you are extremely susceptible to fraud. And so you saw an enormous spike in the kinds of frauds that are outlined here. Lottery sales, online gambling, pyramid-type sales, all of those things. And you saw an enormous spike of them. And Operation Choke Point was designed to cut off the oxygen that feeds these scams, which are the willingness of payment processors to process these kinds of payments for businesses that are operating illegally. So that's Operation Choke Point. Let me turn to Todd's point, and then I'd like to make some points about the paper about the FTC that Todd didn't address. So let me start where I agree with Todd, because there are areas of agreement. So Todd ends by talking about his vision for what a productive CFPB would be like. And I think there are a number of elements there that I think I and most other people ought to support. So the first point that Todd mentioned was innovation. Well, innovation has been sorely lacking in the financial services industry. And to the extent that that's a point that Todd was making, I agree. I mean, we have payday loans, we have car title loans, we have all sorts of lending vehicles that turn out essentially to be debt traps for the poor. or for the working poor, because we don't have sensible alternatives. And I think that maybe I misunderstood Todd, but I think he made exactly that point. And I fault the financial services industry and I fault government for not doing a better job coming up with reasonable alternatives. So I would hope that that would be a high priority of the new CFPB. Inclusion to the non-banked. Now, Todd and I have different narratives about why unbanks have risen, why the numbers of unbanked people have risen. Banks fled poor areas during the economic downturn. There are huge swaths in this country where there is no bank. You go to my wife's town in Milwaukee, there are square miles where there's not a single bank in poor neighborhoods. The same is now largely true around parts of Washington, D.C. So I think there are multiple causes as to the rise of the non-bank, and I don't doubt that Todd is right that some of the post-downturn reforms may have had a role in that. But we need to find finance institutions for people who, by and large, the banks don't really care about servicing because their incomes and their deposits are too small to make much of a difference. Choice. This gets back to the payday loan question. I agree with Todd. Yes, there is a similarity between overdraft protection and payday loans. The problem, of course, is in order to need overdraft protection, you need some form of checking account. And so I think there are areas of common interest and common concern, but I think that Todd's criticism of the post-downturn statutes is overblown. First of all, remember what got us here. We had the worst financial crisis in the country since the economic downturn of the late 1920s. Why? In large measure because the regulatory policies that preceded the downturn were bad. They loosened the reins on all sorts of lending. The people who were hurt by the downturn primarily were not the rich. They were the working poor. And the spillover of the downturn remains very much there today. Most of the wealth that was wiped out for the working poor in the downturn has not reappeared. So I think there's some serious problems with our financial regulatory system, but I think Dodd-Frank on the whole was an important step forward. I think the creation of the CFPB was an extremely necessary tool. Just even if you think about the anti-fraud apparatus of the federal government. I mean, every year, 1 out of every 7 Americans is the victim of fraud. That's not a contestable statistic. And yet we have we have a very antiquated, thin line of defense against fraud in the United States. The FTC, Bureau of Consumer Protection, has maybe 450 people, which have many other jobs to do. State AGs, very thinly staffed. And private enforcement is no way to fight big fraud. And so the creation of the CFPB, I think, was essential for a variety of reasons. The Card Act tried to respond to issues that had arisen during the downturn, as did Dodd-Frank and as did the Durbin Amendment. If they have not turned out exactly the way people thought they might, well, maybe there's some reason for fine-tuning it. But by and large, since the financial reforms went into place, this economy has grown. It has grown steadily. I know President Trump is taking it, sort of claiming credit for all of this, but these reforms are harkened back to both the stimulus package and these reforms in the financial services market. Let me just spend a couple of minutes talking about what I think are some of the most serious problems in the paper with respect to the FTC. It makes a number of claims that I think are just not accurate. For example, one claim is that the FTC statute only allows it to get consumer redress in fraud cases. Now, I've written an extensive rebuttal to that claim in Antitrust Law Journal, but let me just Let me just tell you the irony of this. Section 13 of the FTC statute was passed in the 70s in order to give the FTC access to the courts. So if there was a scam that was ongoing and hurting consumers, if there was misleading advertising that was false and deceptive and deceiving consumers, the agency could, instead of filing a complaint administratively, go into court and get redress. And this was an enormous step forward, because under the FTC statute, none of the kind of injunctive remedies, immediate injunction, disgorgement, restitution, rescission, the appointment of a receiver, none of those tools, none of those remedies are available by the commission. And so Congress wanted the FTC to be able to do all of those things. There is nothing in the FTC statute that limits redress only to cases involving fraud. In fact, the statute did not even mention the word fraud at the time. And the irony, of course, is that the people who first started using this power was Tim Uris and Howard Beals. And now they claim, because they no doubt have clients in this situation, now they claim, well, we didn't really mean it. We only meant it with respect to fraud claims. And this is important because increasingly the agency has been seeking redress in cases involving advertising. So when I got to the FTC, we started bringing cases against advertisers who were making demonstrably false claims about their products. And the most important of these cases, a case involving Palm Wonderful, that was making claims that drinking pomegranate juice would help protect against heart attack, would help protect against recurrence of prostate cancer, and would treat erectile dysfunction. I mean, I sort of felt a little targeted there. I mean, they were going for a particular audience, right? But the problem was that the company had done these random controlled trials that showed that their product didn't work. And instead of not making these claims, they cherry-picked little portions of trials and made very aggressive claims about how science backed up their claims. And we sued them. The case was tried before an ALJ, and ultimately we prevailed in the DC Circuit. Now, the case is important because it establishes three things that are not at all mentioned in the article. One is the First Amendment is no defense when you lie. The principal argument made by the company was, we have a First Amendment right to report those parts of the studies that we think are salient. Well, the court rejected that argument. The second is a claim that's made in the article that the FTC has changed its substantiation standards. That isn't true. The Palm case was tried under the longstanding reliable and competent evidence standard. So the argument that somehow the agency has moved the needle in terms of substantiation is simply incorrect. The case was tried under the same standard that has been used for decades at the FTC. Yes, the remedy sought in that case is a different remedy. Why? Because courts had found that the old standard, the competent and reliable evidence standard, meant really nothing. And so the FTC was losing cases that were contempt cases brought to enforce prior orders. And the court said, look, as long as they can point to somebody who has a degree who says this is competent, reliable evidence, even if the weight of scientific evidence is completely decidedly against them, we're going to allow that claim to go forward. And so the FTC, as a matter of remedy in cases involving false advertising, started to be much more specific about what was being required. That is very different than prescribing a standard of practice. It says if you get caught because you don't have competent and reliable evidence, we're going to impose a stricter standard on you as a matter of redress. That's the origin of that standard. And I guess the last point I'd like to make is there's a substantial discussion of data breach in the article. Once again, the agency's work on data breach, which hasn't really evolved, was started by Tim Uris, who I think still teaches here, right? Tim is a faculty member here. I'm sure he's isn't he on the paper?
Yeah.
Yeah, well, this is Tim's fault. If you want to blame anyone, I'll send you his office number. You can go and complain to him. But the reason why, and this is why I'm unhappy with the failure of the authors to address the statute, is the agency's mission is not to rectify harm when it happens. If you read the statute, the agency's mission is to prevent unfair, deceptive acts and practices. And there are many harms which are not remediable. Data breach is one of them. If you look at the complaints filed with the FTC, there's a Sentinel database. We get about 2 million complaints a year, but there's a special one for identity theft. And you see the numbers of people seeking the FTC's help in restoring their identity. That's why they come to the FTC. There are all sorts of affidavits and other documents you need, which people can just pull down from the website. The rise in identity theft directly correlates to the rise of data breach in big box companies. And if you look at the economics, which my friend Todd likes to do, you'll see study after study finding that the economics cut against the consumers in this area. Why? Because the loss to a company like Target that suffered a massive breach is trivial in comparison to the money it would spend to make their system more robust. You know, the RAND Corporation has issued study after study basically saying the economics incentives lead to massive data breach. And the FTC, of course, has no initial finding authority. All the agency can do is basically say, don't let this happen again. The same is true with the FTC's work in privacy. There are all sorts of arguments in here about consumer preference and why the FTC should follow consumer preference. Well, we do. If you look at every single one of the privacy settlements that we engaged in, the operative portions of the consent decrees are, first, don't lie to consumers. Okay, that's not a big one. The second one is if you're going to change your privacy settings in a way that will enable third-party sharing that the customer has not consented to, you've got to get their consent. And this was born in the Google Buzz case, where Google released, they claim inadvertently, but they nonetheless released contacts information of millions of Americans, including psychiatrists who had their list of their patients released. And there was an enormous hue and cry. We heard from the consumers. Consumers were outraged that settings that Google had promised would always remain confidential were now available for anyone to see. And so if you look at the consent decrees in those cases, these are not prescriptive consent decrees. These are decrees that simply say, follow the law, and if you're going to make a significant change in the way you're treating this data, you can't do it without giving consumers a choice. Thanks so much.
Thank you, David, for the great and insightful and deep comments. But I think I need to give some time to both Todd and Tag to rebut.
Well, I know we want to get the questions, but I just want to take 1 minute and reciprocate with David and agree with some of the things he said to start with which is I agree with both David and Chuck in some sense about Operation Choke Point, right? As the FTC did it, as David said it makes sense, right? The idea of basically being a knowing party to facilitating a scam and a fraud, there's a logic to there, right? To doing sort of those sorts of things. It's a huge problem, though, when you get into Chuck's world, though, right? Where you're using something like reputation risk, which is you have a bad reputation because I don't like you, right? It's basically a circular argument, right? And to do it in the back room, to do it without any written records, any of these sorts of things, to perfectly legal businesses, that's a completely different story from what David was talking about. And an interesting example, this actually applies to payday loans, right? Which is David is target on, right? That looking at things like chargebacks is a good proxy, or I think he said a signal that a scam is going on. The way they applied that Operation Choke Point, though, is they said, wow, it turns out payday lenders have a lot of debts that don't get collected, right? Therefore, it must be a scam. It's like, well, no, the alternative is payday loan customers are poor, right? And don't repay their payday loans, right? That doesn't make it a scam. It doesn't make it a fraud if people can't repay their payday loans just because they don't have enough money to repay their payday loans, right? You may not like that. You may think that's a subject of regulation, but that doesn't make it a scam. And in some sense, I think the logic was taking the chargeback model, which makes sense, applying it to basically somebody who doesn't pay their debt for some other reason. One doesn't follow from the other. And so I think that's the interesting tension here. Is it makes sense as a nuanced, logical tool, but it obviously, in my view, became a subject of massive abuse in the Operation Choke Point operation.
Well, let me kind of follow on that point and pile on just a little bit. But first, I will reciprocate as well. David said some nice things about me as he opened, at least. And we go way, way back to the days when David was, a renowned litigator, really extraordinarily gifted and effective litigator. Candor, I guess, does require me to note he applied his extraordinarily talents almost unerringly in defense of some really wrong-headed position, but because he was so gifted, he oftentimes prevailed, unfortunately, but and sometimes against me, even more unfortunately. But anyway, as you can tell, we're very fond of each other. But I have no brief for scams, illegal scams. And I mentioned at the outset of my remarks that among the list of 30 high-risk institutions or industries, if you will, there were many, several anyway, that it's hard to imagine there's any legal basis for. And so putting pressure on banks to discontinue dealing with outfits whose business model is deception and fraud is not something that I would object to. I don't represent Ponzi schemes, which are among the types of business models, I guess, that are on that list of 30. But I do represent law-abiding, regulated payday lending organizations. And I applaud the FTC for its regulatory challenges to the government grant schemes and anything else that the FTC has determined either industry-wide or members of an industry are engaged in fraudulent, deceptive, unfair, improper, illegal practices, wrongdoing of any kind. I have no brief for that. And I also have no brief for members of the payday lending industry, such as those who, as David mentioned, affiliated with Indian tribes and attempted to avoid regulation of any kind, and were indeed engaged in many of them, if not all of them, in some very deceptive practices. But one doesn't need the backroom Operation Choke Point reputation risk regulatory abuse in order to attack those fraudsters. We have the proper regulatory techniques, the laws on the books, to go after them. What we shouldn't be doing, and what the law, I believe and certainly hope it turns out will not countenance, is using these kinds of techniques to go after industries that at least include very, entirely lawful and law-abiding members, such as my clients.
So now we have like 22 minutes for question. Is there? Yeah, I think there is a microphone, and it might reach you. All right.
So listening to this discussion, I'm reminded, my brother used to work for the IRS years ago. Here we go. That's all right, I'll just speak loud. He used to work for the IRS years ago, and he said one of the internal mottos of the IRS was, "What's the use of having power if you don't abuse it?" So whether or not, it sounds like you have both things going on. You had some sort of systematized, politicized actions that were wrong by the regulatory agencies, but you also had the regulatory agencies going after individual bad actors, which you all agree is a good idea. My question is, what about the individual regulators who sort of exceeded their authority, in some cases unlawfully exceeded their authority? Should we have more remedies that go after individual regulators that do that?
Remedies such as, excuse me? Drawn, quartered. Well, yeah, it does. It certainly appeals to me that regulatory agencies and individual regulators that abuse their authority, that the democratic process has vested them with, should not just get away with that. They should, at a minimum, be removed from their positions. Whether or not additional types of, say, personal liability for damages or even criminal liability should follow, it depends, I think, on what it is they've done. But what I've been talking about is not a rogue regulator or two that has, decided that this is something I want to take out and to choke off. I quoted from the Chicago Regional Office earlier, stating that payday lending is, we believe, something that's unacceptable for a banking institution, and so we're going to come talk to you about getting rid of it. That's an institutional regulatory abuse.
Let me make a couple of additional comments. There are lots of institutional controls that are designed to guard against that. And there are some that are very effective. So for example, if you read Chuck's paper, much of the information he is using comes from congressional investigations. Those congressional investigations, I assume, target the individuals who are responsible for what Chuck claims, and is likely so, to be overreaching by certain individuals within a bigger agency. And every agency has, in my view, at least the ones that I'm familiar with, have internal controls to root out the people whose motto is, what's the sense of having power if you don't abuse it? My sense is that most people who work in government are very much concerned about not overstepping their authority, but using it. And I do think that, we have congressional controls, we have GAO investigations, we have internal inspectors general. There are institutions that by and large do a pretty good job, which is why the kind of abuses Chuck is talking about I don't think are everyday abuses. I think they're uncommon.
I certainly tend to agree with those points. We also have, ultimately, thankfully, the check of the judiciary. If you can, gather enough information to, to put together a legitimate complaint.
Yeah, I just want to say, and I want to speak directly to the rogue, I don't want to speak to the rogue individuals, but I think the larger issue here, to my mind, is what Wayne Cruz at CI refers to, the growth of regulatory dark matter, right? The increasing use of things like guidances and letters and dear colleague letters and backroom type things, all these these sort of things that have grown up in the interstices of the regulatory state, that aren't notice and comment rulemaking, that are not formal enforcement actions, right? And especially in an industry like financial services, where the regulators are so intertwined with the industry and became even more intertwined after they gave them all our money, right? Those ridiculous taxpayer bailouts, right? And all the strings that came with bailing those guys out have kind of gotten their hooks into there, and all the sort of give and take in financial service industries, especially a strong example of this. That's where I think is the interesting part of this, right? Which is, that's a story. It's not just a story of the ends of what they accomplish, but Operation Choke Point is also a story of the means, right? The ability of regulators to sort of nudge, nudge, wink, wink. If you don't do this, we can, audit you again and cause you some pain, right? Or if you followed the Ally settlement and the way the CFPB structured the Ally settlement to try to make a point about auto lending, where basically the government owned 2/3 of Ally at the time, and so they're kind of negotiating against themselves. And then over here, Ally wanted permission from the Federal Reserve, I think, to become a bank holding company so they could issue these things. But they could only get that permission if they got a clean bill of health from CFPB on the investigation the CFPB was doing, right? So it was kind of all intertwined, and that gave them leverage over the company, right? So I think that's sort of a larger picture issue, which is, what is the role of notice and comment rulemaking, formal enforcement actions versus all this this regulatory dark matter stuff that's kind of grown up, and the give and take that is kind of, as the paper says, kind of regulating in the shadows.
Yes. I think there is a mic. Yep.
There you go. It's working. Yeah, we give you guys the mic because it's being recorded, so that's why I wait for the mic.
Great panel. My question is for David Vladeck. I have to say first, I really disagree just from the presentation we heard today about your initial characterization of Todd's paper as being anecdotal. Because I have to say I personally was very impressed with the fact that it was full of empirical, evidence-based research about what I would call the unintended consequences of Dodd-Frank and the Card Act and Durbin. I mean, that was really the part of it that was the most striking. Now, as I would characterize your remarks, and I'll have a question for this in just a minute, would be to say, go back to the initial reasons for this coming out of 2008. It was all well-intended. Personally, I would say 2008 is the ultimate example of unintended consequences, in that it came out of an effort largely by the federal government to provide mortgage credit to people who shouldn't have received mortgage credit. They should simply have been renters. But even if we put that aside and said that 2008, we just had a very big downturn, and now we're trying to redress it. How does that in any way undercut the validity of the points made as to how it appears to be hurting the very people that it was intended to help? In other words, do you think it's a good thing that low-income people now cannot get credit cards, are not allowed to have bank accounts that actually bear the cost of providing those bank accounts? It's an easy thing to say, and I realize you're here in a rebuttal format, but it's an easy thing to say, okay, if there are extensions, we should change it. It sounded to me like actually a lot of your remarks were not inconsistent with the reforms that Todd was suggesting.
So let me say three things. First, I wasn't really talking about the CFPB part of the paper. Deepak, that was Deepak's job. Deepak's not here. So my background is at the Federal Trade Commission, not at the CFPB. The Federal Trade Commission doesn't have regulatory authority over financial services organizations. So I should have been clear that I was not talking about Todd's part of the paper. I was talking about the bulk of the paper, which addresses the Federal Trade Commission. Second, I don't want to get into minor disputes about what the CARD Act has done, what the impact is, why there is a rise in unbanked people, because I think it's a much more complicated story than Todd tells. I think the exodus of banks from large swaths of poor communities in the United States preceded the CARD Act. And so I think it's a much more complicated story, but it's not one that I came here to talk about. So I don't want to fence with Todd about the specifics. My point is we know what the problems were that caused the downturn. I agree with you. You said, the mortgage market was geared towards allowing people to buy homes that they couldn't afford. And that was a precipitating cause of the downturn, right? So one of the things that Dodd-Frank was aimed to do was to avoid the cascade of financial crises that followed from that, from the failure of major institutions. There's a reason why the government owned 2/3 of Ally Bank. Ally Bank was the GMAC. It was the General Motors lending arm. And when General Motors took a hit and the auto industry took a hit, so did Ally Bank. So all of these things are interrelated. And while I don't agree with all of Todd's criticisms of Dodd-Frank, CARD Act, the Durbin Amendment, I think the reasons for example, the exit of banks from poor communities has much more to do with the economics of lending to poor people than any of these statutory reforms.
And in defense of David, his criticism of my paper is largely anecdotal, is largely valid.
Would you tell great anecdotes?
Let me just add, one thing I want to make clear is I actually agreed with the concept of something like the CFPB. I think a very compelling case could have been made to just give it all to the FTC, who's been doing this for 100 years.
Yeah. We came in second.
But the idea of having a one unified, having all the consumer financial regulations under one roof make compelling sense to me. And David has been at that table just like when I was at the FTC, where it's like a meeting to do anything on financial regulation. It's like a United Nations meeting, right? It's the FTC and HUD and Fed and the OCC and the OTS and NCUA. I mean, it was just like, it was crazy, right? And especially in this world where now so much credit is interstate. And as I said, so much of it is so interrelated, and the products that consumers are using and that compete against each other don't fit in these regulatory silos of banks and payday non-banks and all this different sort of stuff. So that idea of having an agency that could systematize, modernize, and treat the entire consumer credit ecosystem as a whole, I think was a very sound idea. And there were a lot of different ways you could do it. And so I want to make it clear that my objection is not to that. I don't think the system we had before this worked very well. I think that what we have now is an opportunity to, as I said, to draw the trade-off in a little different fashion, to balance these different sorts of things and weigh some things that I think have slipped through the cracks or have been underappreciated over the past few years. So I just want to make that part of it clear.
Gentlemen here.
I was wondering if you could address the concept of reputation risk and whether reputation risk is maybe inherently subject to abuse. Because I've seen reputation risk in many bank exams used to create sort of a shadow law, so that something that is not illegal but is disfavored is attacked. Even if it can't be attacked in a consumer compliance exam, it will be part of the safety and soundness exam. And you can use reputation risk to effectively, it's another type of dark matter, I guess. So you seem to somewhat defend reputation risk, but is that a notion that is simply too subject to abuse that it should not be a criteria in bank examinations or other examinations?
I don't object to reputation risk writ large, and I think it, in its original narrow and tightly focused formulation, as among the risks, like compliance risk, among the types of risks that banks have to be aware of and have to be concerned about, are the reputation risks to the bank itself, of its own reputation. I think that even that, like any, I guess, regulatory metric, is something that can be abused. But once you make the bank responsible for the reputations of its customers, and you suggest that the bank's own safety and soundness is itself at risk because it's doing business with certain customers that may have a, quote, unsavory, that's a word that in the internal documents that it came up in discovery, is often used, has unsavory reputation. I think that is entirely subjective and is a recipe for boundless regulatory impositions. And this may be an obvious proposition, but Chairman Henserling of the House Financial Services Committee, if I could just share this quick observation that he made about this form of reputation risk. It could ostensibly invoke to compel a depository institution to sever a customer relationship with a small business operating in accordance with all applicable laws and regulations, but whose industry is deemed reputationally risky for no other reason than that certain executive branch agencies disapprove of its business model, even though it's it's a lawful model and a law-abiding entity. So, yeah, my opinion is that's the fulcrum. That was the fulcrum for the whole operation, and without it, it would have been much more difficult to achieve these anecdotal abuses that were widespread.
I'm curious what you guys think about the really, I think, complicated dichotomy that we now have between privacy, innovation, consumer protection, and I think Todd referred to the sort of the parent state. Innovation brings with it a lot of complicated concepts, and so we have all kinds of disclosures required that consumers, even the most sophisticated ones, don't read or wouldn't take the time to read, or perhaps as sophisticated as they are, wouldn't understand, not considering even what would be the least sophisticated consumer. So how to match innovation, which consumers want, with the need to protect them, with the farce that there's all these disclosures that people don't read. How is that really protecting people?
I think the FTC has struggled with that question, and I think the balance that it has struck is to try to, as much as it can, to avoid being a speed bump on the road to innovation, while at the same time sort of try to lay out some basic principles that we hope but don't enforce the industry to follow. So take mobile phones, for example. When mobile phones, the first generation of mobile phones were information sharing devices. There's almost no way to control the flow of information out of them. It's very easy there's no encryption function, so forth. And the agency pushed hard for the device manufacturers to start thinking about privacy when they were designing the next generation of phones. And if you look at today's phones, particularly the iPhone, it is really built in a way that tries to enhance privacy. Now, if you look at the FTC's orders in privacy fields, and their orders against most of the major companies, they're not at all prescriptive. And the theory is that prescriptive regulation in a dynamic environment like technology these days is just like building another Maginot line. It's just going to be overcome immediately. And so, if you look at the agency's work on this, there are a few lines in the sand that the agency draws. That devices that are designed in ways that enable basically inadvertent captures. One of the settlements that's criticized here is against the phone manufacturer HTC. HTC manufactured a phone where it was very easy for anyone with crude knowledge to basically enable the speaker function on your phone and capture all your conversations. There were many other sort of design problems with that phone. And we brought an action basically saying you got to patch this because you haven't told consumers that a 16-year-old with a reasonably proficient, understanding of how these things work could basically listen into all of your conversations. And so I think the agency has tried, it appreciates the concerns you've raised and is trying to be a responsible regulator to avoid sort of the most significant risks about privacy invasion without interrupting innovation. The other case that I talk about, because it was quite controversial, was there was a software manufacturer that designed programs for rent-to-own computers that were sold by errands. And the program allowed not simply the renting company to activate a geolocation device, which would, of course, help retrieve the computer if the people stop paying, but also to activate a keylogger, which would mimic everything that the consumer was doing on the computer, but also could remotely activate the cameras that were on these things. And guess what? If people can watch other people in their homes doing what people do, there's plenty of evidence that these cameras were activated all the time. Now, we brought that as both a deception and an unfairness case because our theory was that invading somebody's home like that without their knowledge and consent was both unfair and deceptive. So those are the kinds of cases the agency has brought. And I think they're well within the agency's mandate to prevent unfair and deceptive acts and practices. And the commission, on a bipartisan basis, has agreed. But those are the sorts of things that the agency's most worried about.
Can I just add one word on that? I know we're running out of time, but I'm going to give sort of a non-answer answer, which I think is still an interesting answer, which is sort of pressing on beyond, I think, the harder cases and the more general paradigm that you're asking about, which is, for example, a trade-off between big data and privacy, for example, right? And you see this in fintech, for example, right, where fintech is basically engaged in data mining, right, to find, use different types of things, utility bills, all these different sorts of things that will basically allow them to bring in people who are actually better risks than they look like, right? People who don't have established credit, people who don't have good credit scores, this sort of thing, right? The problem is the ability to include implies the ability to exclude, right? Which is, that also means some people who look like good risks maybe aren't as good a risk, right? Once you bring in these sorts of things, right? And you think about convenience versus security, right? We could have a lot more payment security if we told Amazon they're not allowed to store our credit cards. Does anybody want to have a law that says Amazon can't store our credit cards? Of course not, right? So we're immediately into the world of trade-offs, right? And here's what I think is the big picture on this is, at least in Washington, maybe not in your states because of how, but at least in Washington now, Washington is very, very bad at processing trade-offs. that the political process right now has a lot of difficulty dealing with things like unintended consequences or trade-offs between, say, big data and payment security or all these different sorts of things. And so I don't know what the answer to that is, except that the question you ask, I think, is one of the most difficult and most compelling questions for us to get our hands around, which is this question between big data on one hand and privacy on the other, and how we draw those connections. And so that's why I say it's a non-answer answer. I don't know the answer, but I think it is a huge question for consumers in the economy for us to try to figure out and to do it in a way in which we all can come around the table and understand that there are trade-offs here and talk in a serious grown-up fashion about cost benefits and trade-offs in a way that helps consumers overall.
And in light of the time, I'm going to give an unqualified non-answer.
So please join me to thank this wonderful panel.